All right, so good evening. Tonight is a very exciting topic. That's actually out of all of them, it's my favorite topic. So tonight we are going to talk about investing and investing for retirement and also some other type of investments, but mainly for retirement, mainly for later long-term investing. The difference between people that are rich and people that are poor, it's a state of mind. It is not related to your income. It's related to your state of mind. Um, uh, People that are rich, why they're rich? Do you think they win the lottery and money just comes like that? No, they're rich because they thought long term. They had a vision for long term. The people that are poor, usually they think about enough money for until Friday, right? Or until the end of the month. And they spend all their money. At the end of the month, they have zero or they're in debts, and they never get ahead. So to be a successful person, there are many ways to be successful, but one of the ways is with money, because there are only three things you can do with money. Do you know what are the three things you can do with money? The first thing is spend it, and we're always good at that usually. Save it and give it. Right? So there are only three things you can do with money, and you ought to do all three of them: save it, spend it, and give it. And so tonight we're going to talk about how to save money. Saving money is usually not a talent that we have naturally. Um, Most of us, we're not natural savers, but some people are. Some people are more of a savers, but usually it's something you acquire in life because you've had trouble in life, or you've had difficulties, and you were planning for the future when you saw that something failed in your plan. So saving is extremely important. And you know what? I'm really happy that tonight we have two young people, because the younger you are, the more successful you can be in this plan. I wanted to share again with you that graph that I showed you at the first session. This is, if you remember, the story of Jack and Blake and the power of compound interest. So you see here, this is, both of them are twins and they're 21. And Jack started investing at the age of 21. He invested $2,400 every year, $2,400 every year for 9 years. That's not a lot, right? $2,400, 21 years old, that's when you start working, you start having an income, small at the beginning, but usually, you may be at your parents' house, or you may be a beginner in life. You don't have a lot of expenses. You don't have a lot of bills. So he saved about $500 a month, which is great. He saved for 9 years and then he stopped. Now, when he stopped, he was 30, right? Now his brother Blake, he saw that, his brother Jack is doing really well. So he started to invest as well. And he also invested the same amount, $500 every month, until he was 67. That's 38 years of investment. You see the green, right? And the green is Jack and the yellow is Blake, right? So every month, Blake started to invest when he was 30. Guess what? At the end, you see here the results. How much do you think, everyone had? Look at that. Look at Jack. He has $2.5 million when he retires at 67, and Blake never caught up. He still has a 1.4 million, almost 1.5, which is amazing, but he never caught up. And so this is why I want to teach tonight about the power of compound interest, about how you can plan as early as possible for retirement. People think that retirement is, you need to worry about it only when you're 50. But no, it's important to invest very early in life, very early. So who do you want to be, Jack or Blake? I want to be like Jack, right? I want to invest as early as possible. And, I learned about this plan when I was in my 30s, early 30s. And I wish I learned it before I was 20, because, by now I would be already a millionaire. And so it's very important to learn what compound interest is. So it's a very good habit to save. Now, how much do we save? How do we save? I'll talk about that in a minute. But what is compound interest? Have you ever heard of that? Compound interest is the interest that accumulates as you save every year, right? So if you save $1,000, you have some interest to make it easy. Let's say 10% interest, right? So the first year you have $1,000 and you invested at 10% interest. What do you have after a year, at the end of the year? You have $1,000 plus your 10%, which is $100, right? So you have $1,000 and $1,100, $1,100. So that's what you have at the end of the first year. Now the second year, the interest is not on the $1,000 only. The interest will be on the $1,100. That's where the interest will be on. And so every year you have interest over a bigger amount, and it's an exponential curve. For those of you that love math, exponential, it means that it's growing faster than just adding every month. It's not just about adding; it's about multiplying, and that's why it grows really fast, and that's why you need time for it to grow. There is not much difference in the first few years. In the few years in the graph that we saw, I can just show you again. In the first few years, the difference is not big. Look at that. They're 40 years old. Look at the difference. It's very minimal. But as you age, difference gets bigger and bigger and bigger. Actually, if you invest well, and we'll talk about how to invest, but if you invest well, your investment should double every 10 years. If you don't add anything, you put $100 and you leave it there, it should double every 10 years. And so that's the power of compound interest. Now, how much should you invest? Well, there are different types of investments, but today I'm going to consider mostly long-term investments. There is no reason to invest for periods of time that are shorter than 5 years. You should never invest for periods of time that are shorter than 5 years. If you need to buy a car, or you want to buy some expensive furniture, you can save. Just put it in the bank account and savings accounts. Just save, and that's it. But if you're planning for 5 years or more, then it's worth putting it in an investment plan. Now, how much should you invest for retirement? Now, if you remember, if you followed all the plan from the beginning, you have no debts anymore. You have a fully funded emergency fund of 3 to 6 months of expenses. So in case you lose your job, you're able to find another one without any problem. You have already planned for the kids' college. You have plans for your monthly expenses because you have a budget. So now you bought a house, but you still have some room in your budget because you did not spend everything. So now, how much should you invest? You should actually invest 15% of your income. 15% of your income. Your net income should be invested at 15%. Now that's not a very precise number, but it's a number that works for most people, whether you're young or whether you're old. Now if you're closer to retirement, of course you'll have to invest much more than that. So, but usually 15% for most of us is a great number. And so when you do that, you have to think very long term. So it's not just putting your money under the mattress and forgetting about it. You have to invest it in a good place. How much, if I may ask, among you, how much does your bank offer you when you go and you tell them, I want to open a savings account? How much do they give you for a regular savings account? Usually it's around 1%, sometimes 0.5%, right? How much they offer you if you want investments? Any of you have asked already, you want to invest somewhere, that they recommend? What rates do they show you? Of course, nothing is guaranteed, but what do they show you, average? Anyone can tell me? Have you looked into that before? Maybe in your RRSPs or in your TFSAs, how much they give you? Anyone knows? You can unmute yourself if you want to answer.
It's 1%, sometimes 1%.
Yeah, usually that's right. Usually 1%. And if you look for like recommended investments, like if you have a little bit more money and you want to invest, you go to them and you ask them how much they give you. Claudette, you wanted to say something.
Yes, it's a little, I don't know exactly how much they give you, but it depends, I think, on the plan that you're on, eh?
Right.
Your investment plan.
So if you look for the best interest rates, usually they give you 5 to sometimes 6%. And that's considered great. That's considered amazing. You go to the bank and you ask them for the best interest plan they have. They give you 5 or 6%. Do you think interest matters or safety matters more? What is more important? For most of us, we don't know, and we don't know the investments. We think about the stock markets. We're afraid because the stock market goes up and down, and it's very risky. We've heard of people losing all their money in the stock market, and so we want to be very safe. So we go to the bank, and the bank says, "How confident are you about the investing?" You're like, "Well, I'm not sure. I don't know much." So they recommend something very safe, guaranteed. They will guarantee you, 3%, 5%. And if the market goes down, they say, well, you will never lose your money. And so people trust that and they put their money there. Guess what? Remember that I told you you should never invest for a period of time that are shorter than 5 years. Now you look at the history of the stock markets and you remember that you want to look at long term, right? So look at the period of time that have been negative. You take a 5-year period of time and you look at how many times the stock market has actually gone down in a 5-year period of time. There are two. when the big crash in early 1900, when was that? 1929, something like that. So the market crashed. I'm not exactly sure which year it was. I know it was probably before the First World War. But anyways, the stock market crashed, and it took longer than 5 years for the stock market to recover. Now, if you look at the second period of time, it was actually 2008. 2008 took actually 6 years to recover instead of 5, right? So that's why you should never invest for a shorter period of time, shorter than 5 years, because within 5 years, the market goes up and down, up and down, up and down. And if you buy when it's up and you plan to invest just for 2 years, and then you pull your money when it's down, then you lost money. But if you invest for a long period of time and you don't touch the money, there is no reason for the market to crash and not recover. So when people tell you, oh, the market has crashed, it's the end of the world, everything is down, like what they told us this year in 2020 in March, right? The stock market crashed. It lost 30%, right? 1/3 crashed. People were afraid, and what did they do? They pull their money out. So what does it mean when you pull your money out? That means you actually acknowledge the loss. You actually say that you have lost the money and you pull it, so you have no chance of leaving it there for it to grow back again. So when it crashes, you don't invest more, you don't pull your money away, you just wait. You just wait. And the market recovers. Now, guess what? In June and July and August, the market went up 200%. Right? So it went up higher than what it lost. So those people that withdrew their money, they lost something and they never recovered. Those that left the money there, it went down and went up again. And, now they actually earn more money. That's why the rich always benefits when there's a crisis, because the rich, I consider us to be the rich. We are in the richer part of the world. And if we have a house under, a roof above our heads, that means we're rich. We have cell phones in our pockets, that means we're rich. And so those of us that are in that situation, when when there's a crisis, we actually have the ability of being better off. So let me just show you a little bit the curves of the markets. So there is one thing, you've probably heard of it, when they say that the market crashes, what do they look at? They look at an index that's called the S&P 500. Have you heard of that? S&P 500, right? It's the Standard & Poor 500. It's an index that's designed by the Standard & Poor company that is based in the US, and that selects the 500 biggest companies in the US and compiles their index to see the trend, if it goes up or down. So it's basically representative of the economy. And let me just show you, all right? So let me just show you a little bit this index. So this is the S&P 500 index. And you see the chart here. This is 1 day of trading. So it goes down and up. Now these are 5 days of trades. So it went, down a little bit again. These are 3 months. You see how it goes up and down, up and down. Now, if you look at 1 year, you can see already a trend, right? This is how it went up. Then this is March. When it went down, it crashed. And look at that now. Look at where we are compared to March. So from March to now November, we actually more than doubled, or almost doubled actually, what was there at the lowest, right? Now, if you look at all the history available since, I think actually it's more than that, but since the 80s, look at the trend of the S&P 500. You see how it's going up and up. It goes down a little bit, it goes up, down, but look at the trend in the past few years and since the 80s. There is no way that you take a 10-year period. There's absolutely no 10-year period when it went down. It's always going up and up and up long term, because the economy is booming. The economy is developing. The world is developing. People are getting, more comfortable. So unless Jesus comes back, and we know he will, and the world will be destroyed, the economy will always go up. If there is a crisis so deep, then that the market will crash and will never recover, that means the whole world will stop functioning. In March, if you remember, when the market crashed, people went to the stores to get toilet paper. They got food and everything because they thought we would never recover from it. So if the market crashes and never recovers, it means this is the end of the world, basically. It's at least the end of the world that we know today. So there is no reason to be afraid when you get familiar with the stock market and the history of the stock market. Of course, nothing is guaranteed, but it's like a house. When you buy a house, nobody guarantees you that it's a good thing and that your house will gain value. But everybody knows, and everybody's very comfortable buying houses because we know that houses go up long term. There might be a crisis. There might be a 1 year or two when the prices go down, but then it goes up again. So people are very comfortable with houses because they can touch it and they can feel it, and but they're not very comfortable with the stock market. So when you invest, you have to be very careful. As I told you, the S&P 500 is an average of 500 companies, you never want to invest in a single stock. Never, I repeat, never invest in a single stock. Because guess what? Averages makes it, it averages out the companies that lose a lot and those that gain a lot, right? So the average is smoother. If you invest in one company, like let's say Enron in the 80s, Enron was one of the top company in the US. And people invested in that company. They had tons of money in there, and then Enron crashed, and everybody lost their money, right? So it's same thing about Apple right now, or Tesla. It's great companies. They make 200% a year of increase, but guess what? They can fail. And so it's never. It's very important never to invest in a single stock, and that's why I wanted to show you what mutual funds are. So mutual funds are, when you buy a mutual fund, you actually pay into a pool of money that is managed by a team of investment professionals. And this team selects a mix of stocks, bonds, money market accounts, different companies, different financial products, and they include all of that in a mutual fund based on the mutual fund's objective. So every mutual fund, you have thousands of mutual funds. Every mutual fund has an objective, and they try to, that's their business. They study that. They try to analyze the market to reach their goal. So there are some mutual funds that are called, for example, they're called how are they called? Index funds, right? So an index fund is actually trying to replicate the S&P 500, which is the average. So they are actually trying to be average. And an index fund has maybe 200, 300 companies in there, and will try to match the exactly a market. So the average, if you look at the past 30 years, or even before that, but the average return of a mutual fund that is matching matching the S&P 500 is actually 11% a year. So this is what the average mutual fund will give you, right? So average is of course it's not guaranteed, but it means that some years it will go up, some years it will go down, but the average over a long period of time, which is like around 10 years, will be 11%. So now when the bank goes and say, well, I'll give you 1%, who keeps the 10? The bank does. That's why they can guarantee you the rates, because they know they will never lose it. Even if one year they make less than 1%, the next year they will make 20%. So they know they'll always make more money than you do. So you don't want to invest in those plans that the bank give you and where they say it's guaranteed. Well, why is it guaranteed? Nothing guaranteed in life. Why can they guarantee it? Because they know they can make much more money than that. So their risk is very minimal. So if the average of a mutual fund is 11%, what does that tell you? That tells you that 50%, half of the mutual funds underperform, and half are better than 11%, right? So where do you want to invest? You invest in funds that are above 11%, above the average, right? That's where you want to invest. So you have to select mutual funds that outperform the S&P 500. And it's not hard, because selecting mutual funds, you just go and you have like thousands of mutual funds, and you look at those that are above average. You look at the 10-year period, the 20-year, 30-year period, and you look what they bring. So let me just show you here in just a second. All right. All right, so this is called, it's a website that helps you compare mutual funds. It's called Morningstar, and it has nothing to do with the Morningstar in the Bible, but it's called morningstar.ca, and you click on funds, and you compare different funds, right? And so you just go there. Funds are mutual funds. That's what they are. It's very complicated. There are many, many things that are very complicated, but you want to search for long-term performance, 10-year annualized, and you click, and you look at some funds, and you see that this is what they've done in the past 10, every year in the past 10 years, this is what their return is, right? So this is how you choose your funds. You choose your funds among all of those. You don't go for those that are 11% and down. You know, you look at those that are performing more. So for example, I have this one. So now when you talk to your counselor, to your investment counselor, which is free, by the way, you should pre-select some funds, but they will tell you some classes you can't, some series and some classes you can't invest because you're not investing enough. For example, class A, like this one, for example, class A, you have to invest $1 million minimum to enter in those funds. So you can't necessarily invest there. But he will tell you, you know, some funds you can, some funds you can't. Now you have to select four funds among all of those. You see how many there are that are above 11%? That's the first 50, right? So you have a lot of funds to select from that. And you have to invest in 4 types of mutual funds. As I told you, every fund has different objectives. You have to select a fund that is growth and income, aggressive growth, and international. So sometimes they are called with different names, but you tell your counselor you want to diversify as much as possible. So growth is the very large companies. Sometimes they're called also large caps. Very large companies that have been there for years, that are very stable. They go up very slowly, and when the market crashes, they go down very slowly, right? Those are big companies. You know, and so it compiles all those big companies. Sometimes they call large cap. Growth and income is mid caps. So it's a mix of very large companies and smaller companies. Now, so it performs a little bit better because, as you know, smaller companies usually have more potential of growth very quickly. And then aggressive growth, sometimes it's called small caps, small capitalization. So smaller companies that are very growing very quickly, but it can also go down very quickly, startups, right? So you want to have a mix of all these companies. And so when you diversify, you don't put all your money in one. You put your money in diverse companies that are, you know, different companies, different styles of investments. And the last one is international, because you want to use also a little bit the power of big companies like BMW, like L'Oreal, and those companies that are international. Now, when I say international, I only invest in American companies. Why do I say that? It's not because I don't like Canada. It's because the US outperforms Canada by far. So when you invest in the mutual funds, you want to select American companies. They are the ones that will give you a lot more return than Canadian companies. Now, in your international funds, you can have some Canadian companies, you can have some European companies, and so on. But I would recommend to invest more heavily in the US because they bring a better return. So you can invest in Canadian dollars. When you select those funds with a Canadian branch, a bank, and you tell them you want these funds, you will invest in Canadian dollars. There's no conversion rate for you. It's not complicated at all. You just have to tell your counselor what you want. And you have to insist a lot. I can testify. I was helping somebody to invest, and the first thing they offer you is those funds, mutual funds that give you 5 or 6%. They tell you this is the best for you, so you have to insist a little bit. You have to say, no, I want something that outperformed the S&P 500. I want something that will give me more than 11%. Of course, it will never be guaranteed, but it will give you more. So now, if you look at, for example, my personal portfolio, I can tell you a little bit. Unfortunately, I don't have a lot to invest, but I still try to invest the best, right? It doesn't matter if you have a lot of money to invest or very little, as long as you invest something. So my personal portfolio, I have started to invest only since November last year. So it's been exactly actually a year. And this is I have 4 mutual funds, and these are the returns I've had with those mutual funds. The first one gave me 19% since the beginning. The second one, 29%. The third one, 42%. And the last one, 17%. So I'm not expecting this every year. This year was amazing. But it's just to tell you that it is possible and it's not a scam. You go with regular branches, regular banks, and you select the funds that are just the smarter funds. So now, some people will tell you, well, you have to be more careful as you, especially as you come close to retirement. Again, this is for retirement investment. If you're already there, already close to retirement, you should not invest maybe necessarily as aggressively because you want to retire under 5 years. So then once you're close to retirement, once you're close to your 60, 62, 63, then you want to be more conservative and move away from those mutual funds that are very good to mutual funds that are more, a little bit more passive, which are, index funds, which will actually bring you 11% only, which is already great in my opinion. You can leave like half of them aggressively invested and half of them more conservatively. So how do you invest in mutual funds? Any investment accounts can be invested with mutual funds. And when I say by that, it's in Canada, you have mostly 2 investments. It's RRSPs and TFSAs, right? Those are the 2 mediums or the 2 main platforms where you can invest. I would recommend if you, so again, if you follow the rule, it's 15%. So put the 15% as much as you can into your TFSA, tax-free savings account, until the limits, because every year you have limits. So you have to invest until the maximum, and then the rest, if you still don't have, if you still have some more money that you need to invest, 15% is not over, then you put it into RRSPs. Why did I say that? Tax-free savings accounts are tax-free. So you pay taxes now because you invest with your net income, so you have already paid taxes, and then you invest it. And the proceed of your investments when you retire will not be taxable. RRSPs are the opposite. You don't pay taxes now, so you invest with your gross income, and then it will grow, and then you will pull it, and when you pull it, then you have to pay taxes. So now the objective here is to pay as little taxes as possible. So I'm not a financial counselor. You can talk with your financial coach with that. But if you invest the way I do and the way Dave Ramsey recommends and millions of people follow that, you will have, when you retire, you'll have several $1 million, right? My personal goal, and I'll show you that in a minute, my personal goal is 2.4 million when I retire. That's just with investments. I'm not talking about real estate or other things. So when I retire, do I want to pay taxes on 2.4 million, or do I want that to be tax-free? Taxes on 2.4 million is almost $1 million. So choosing which way to invest, either TFSA or RSPs, actually saves me $1 million. So it's a very important choice if you have time for investment. I prefer to pay a little bit of taxes now, but I will pay it on the investments, and I will not pay it on the growth. And the growth will be, it represents most of the investment. Let me just show you here a little bit what I mean by that. So this is an investment calculator, investment and retirement calculator. And I'll do a simulation for me, right? So I enter my age, I'm 35. I plan to retire at 65, maybe 67, we'll see. Right now, let's say I have invested $0 for retirement. And I will invest $800 a month, all right? My return, if 11% is the average, I'm hoping I'll do 12%. But let's say 11%, all right? So 11% is 2.2 million. So look at, all right, you see the pie chart? This is the initial balance, which is $0. I didn't have anything. This in dark blue is my contributions. So this is what I put in through my life in 30 years, right? 30 years of putting $800 a month. I have put $288,000. And all the green is the growth. So now if I pay taxes on this and I don't pay taxes on that, I win more than if I didn't pay taxes on this and I paid taxes on that. That's why TFSA is better, except when you're very close to retirement and then the balance starts to shift. You see how it starts growing? That's the year when I'm supposed to be $1 million, to have $1 million, and how it grows. Now, it matters a lot if you invest 11% or 12% or 3%. Let's say I invest the same amounts monthly, but only at 3% interest. I'll have almost $500,000. This is not enough. That's not a lot. So just selecting wisely your mutual funds will give you a lot more than that. So I'm hoping I'll have 2.4, 2.8, depending on, how much I'm expecting the stock market to perform. All right. So this is how you can very quickly calculate the growth. Now, when I retire, I will have my house paid for. I'll have my kids will be grown and gone. The school will be paid for. I will have no debts, and I'll have 2-point-something millions. Do you think I'll be okay? I think so. I think so. And if Jesus comes back before I retire, then that's it. I don't need money anymore. So this is why it's important to invest wisely. Now, if you calculate, actually, I'm hoping and planning not to touch my nest egg when I retire. This 2-point-something million, I'm planning not to touch it because it's still invested, let's say conservatively at 10%. 10% of 2.4 is $240,000 a month, a year. That's as if I had a $240,000 income a year, which is, 7-8 times what I have right now. So I think I'll be okay. And I'll be able to, give generously. I'll be able to help people, and I'll be able to live and not have any worries when I retire. Most people don't retire completely. They still want to do some activities. They want to still work maybe on the side, or they want to travel, or they want to be spending time with family. Or if they're, sick, instead of going to a nursing home where you're treated like cattle, they could have a nurse at home coming. And you can pay a nurse with 2.4 million, right? So this is helping you have a different lifestyle. And then you also live an inheritance for your children and your children's children. So that's why it's important to invest well. So again, if I go back to the details, 15% of your income saved, invested for retirement. You invest in 4 types of mutual funds: growth and income, aggressive growth, and international. And you have to outperform the stock market, the mutual funds average, and invest for a long period of time, 5 years or more. Usually I recommend 10 years. So if you don't have 10 years in front of you, maybe it's not the best idea to invest. All right, so I hope it helps. One more thing, maybe. Actually, investing in mutual funds is not the only way to invest. Some people are really not comfortable with mutual funds. So if you would rather invest in different things, you have to learn how it works. For example, some people like real estate. They're comfortable with that. Their parents have done real estate. They're very comfortable as owning something and actually being able to touch it. So some people will put their 15% in a house, right? So they'll save 15% every month, every year. They save their income until they're ready to buy a house in cash. Never invest with debts. Remember, debts is over. You invest with cash. So the first house will be really hard. It will take you a long time to invest and to have enough to buy the first house. But then you rent it out, and your renters will actually give you an income, right? You have to repair some of the house and do a little bit of that. But if you don't have any debts, you don't have any mortgage on the house, that money grows really quickly. You still put your 15%, and then the renter will give you his rent every month. Then you save for the second house, and you pay it in cash. And then when you have 2 houses, you have a lot of income coming in plus your 15%. And then you start investing for a third and fourth. And when you start having 5 houses, after you have 5 houses, you can buy one house per year in cash, because you have a huge cash flow if you don't have any debts. So I'm recommending that only to those that know and are comfortable with dealing with evictions and conflicts. It's a little bit harder to invest in the real estate market because you have to deal with people, and sometimes people are not very nice. Sometimes they break your house. Sometimes they bring pets and they destroy the house, and so it's a little bit more complicated. But overall, it can have also a very good rate of return, which is usually a little bit more than mutual funds. So if mutual funds, the average is 11 to 12%, real estate usually would be 15 to 16% annually if you manage it well. So those of you that are comfortable doing that, go ahead. I would still recommend to invest both if you can, real estate and mutual funds, because you have diversification. It's very important not to put all your money in the same basket, all your eggs in the same basket. Also in Canada, you need to know that the government guarantees all your bank accounts up to $1 million. If you have more than $1 million, it's not guaranteed if the bank fails. So if the bank bankrupts, the government will only guarantee the first $1 million and the rest is over. So once you reach, you pass $1 million in one bank account, I would leave it there and open a second one and invest my 15% in the second bank account. So I have less risk. You can have accounts in all Canadian banks, and there are many to choose from, and they're all good, and I will give you more diversification. So I don't know if there's if there are questions. I'm sure there are questions, but basically you have to understand that the longer you invest, the more you will benefit. If I play around with this calculator again, that's why you want to invest earlier. If I had learned that when I was 25 instead of 35, and I still invest the same amount, and nothing changes except how early I plan to invest, instead of 2.7 million, I would have 9.4 million, just 10 years more, right? So as you see, it's exponential. It really grows exponentially. So maybe some of you will be 20 and listening tonight, and you plan to retire at 65, and then you're looking at $17 million. And that's just if you invest conservatively, which is $800 a month is not a lot. Like some people that will earn more than me can definitely contribute more every month. All right. So now I'm going to let you speak. I'm pretty sure you have questions. So what would you like to see? How you have to feel comfortable about, mutual funds, what they are. You have to look at what is being said on it. You have to become an expert, in that a little bit to be able to invest. Slow and steady is the way to go. Don't try to be like the hare and win the race. In the story, the hare and the turtle. You know who wins the race, right? Every single time. Every time I read the book, the same one wins the race. It's a turtle. So slow and steady is the way to go. You should never try to follow scammers that tell you you invest and you will be rich quick. Being rich quick is not possible. I've heard that from many people that I know, and I'm still waiting for them to be rich. So they appear okay because they still use debt. And who gets rich? The bank does, because they still have debts. So they go everywhere. They have debts and investments. And so they pay here, they give money here and they take money there. So basically the money just passes through their hands and goes to the bank. So you want to avoid debt like the plague and invest wisely. Anyone has questions? That can be a little bit intimidating to invest. Some people are like, well, those are my hard-earned dollars. Like, I don't want to give it to an investment. I'm not sure how it works. I'm not comfortable with it. So it can be a little hard. What I did, as soon as I came to Canada, the first year I came to Canada, I didn't know anything about investment. So what I did is I opened an account and I put $100 in there. And I waited. It was about, it was not right away. I think it was about 6 years ago. And I put $100 there. And it was a lousy investment. I found out after, but it was investment I was comfortable about. If I lost it, well, it's just $100. And right now it's $145. It's not a lot, but 45% in 6 years. That's actually 5.6% annually, which is very bad. But at least I got to learn how it worked, right? So if you're not comfortable with investments, just try it out. Give it a shot. Open an account, choose those 4 types of mutual funds, put $1,000 maybe, and just wait a year and see how it went. And that will help you be more comfortable. So are there any questions?
I have one question.
Yes, please.
With your recommended 15% of the income, is that before or after tax?
It's net, 15% of your net income. Yeah, 15%. Okay. You should invest 15%. Now, that's a very good question. That reminds me that I didn't talk about investments with your employer. Sometimes your employer will give you some type of retirement plan. They will contribute, on their own. So it doesn't matter. You should put 15%. Because what your company will give you, usually it's very poorly invested. So it will just be the icing on the cake if you have anything at retirement, but I'm not counting on that. I'm not counting on the government to help me when I retire. I'm not counting on any company, because usually it's very bad investments what they offer. Sometimes you can choose among a selection of 10 mutual funds at your job, it's a little bit better, but usually it will be 6-7%. So it's still not the greatest. So yeah, you should invest after taxes from your net, from the money you earn, you should invest 15%. Anyone else? So if you're 15%, so again, you invest 15%, you take that amount of money, you max out your TFSA, and whatever is left, you put in your RSPs. Your RSPs will actually lower your income ratio or your income, and so you'll be taxed a little bit less. But really, what's important is not so much the taxes you pay now, it's the taxes you pay later on at retirement. Because you're going to pay taxes on $2, $3, $4, $10 million, and you want to pay as less as possible then, because when you have more money. Right now, none of us have a lot of money. So whatever taxes you pay, it won't be a lot. All right. Well, everybody's silent tonight. Do you think?
I have one more question.
Yes, Jacob. Go ahead.
With the RSP account, can you pull the money out at any time or just when you're retiring?
That's the thing too. Okay, so first of all, again, retirement investment is for retirement. You should never, under any circumstances, pull your money out of your retirement accounts unless it's for retirement or to avoid a bankruptcy. But when you pull your money away from your investments, RSPs, you will pay taxes because taxes are due, and you will pay penalties. So between taxes and penalties, it will be around 30%. It's like saying, well, I'll borrow 30%, I'll borrow money at 30% interest. So it's stupid, right? Nobody should do that. But people do it all the time. They pull their money from retirement plans at 30% interest, or kind of 30% penalty, I would say, and they use it for something else. So it's not a good plan. Yes, RSPs are blocked until retirement, and then at retirement, then you take it out at the specific ratio. And you can talk with your investment professional to know how you can, what rate you have to pull it out. And when you're 70, you actually have to pull the entire amount, and you have mandatory disbursements every year. For TFSAs are very flexible, but you have to be careful also when you pull money. If you want to pull money and put it back the same year, you have to be very careful about calculating well, because your investment room is not reset until the next year. So if you maxed out, for example, you have $20,000 and that's the max you can put there. You pull 10,000 and you put it back the next day. It's as if you have contributed an extra $10,000 above the limit, and then you will be penalized 1% a month until the next year. So I don't recommend you that. Again, investments are for long term. Don't pull your retirement investment to buy a car or to buy a house. It's a very bad idea. We talked about that last week. It's a very bad idea to use part of your retirement funds to buy a house, because you're borrowing money from yourself and you have to repay it, and you're disconnecting it. You're like unplugging your mutual funds at the wrong time when it's growing. So it's not a good idea. And you should have enough room. If you did your budget, if you don't have any debts, you should have enough room to save 15% of your income. Everybody should be able to save 15% of your income. You have to look. If you're not able to save, that means you need to raise your income. You have a problem, an income problem. Or maybe a spending problem. Yeah, Jacob again?
Yeah. So if you were to invest in another account in something else other than mutual funds, for example, real estate, like you mentioned, what kind of account would you recommend for that? Because obviously you can't go with a retirement savings account.
Right. So again, if most likely, I'm hoping that you will invest 15% and that you will be able to buy a house within 5 years. So if it's under 5 years, you're saving to pay cash for a house or an apartment. Under 5 years, just a regular savings account is fine. Regular savings account, it pays nothing, but that's not the goal. You want to keep it safe. You don't want to lose money when you're ready to buy the house. If you're planning to buy that house in cash in more than 5 years, then use the TFSAs for that. But I don't recommend, I don't recommend to buy a big expensive house for your first house. Buy the cheapest house you can find, and make it pretty, and put some renters in there, and keep it. Don't try to flip it or necessarily. Just put somebody there, and the rent income that it will give you enough money to buy a second house, and so on and so on. So sometimes people try to be, they try to be smart and be smarter than the system. They borrow money, buy a house, flip it, borrow more money, buy a bigger house, flip it, and so on and so forth. And they try to be rich. People lose millions of dollars doing that. When there's a market crisis, or when their short-term loans are called, they find themselves in trouble, and sometimes they lose everything. They're bankrupt, and they have a lot of, or they have to sell their house undervalued. So it's not a good plan. Slow and steady is the best. Buy a house in cash, smaller house you can find, ugliest house, put a renter there, and the cash that's coming from this investment will allow you to buy a second one and a third one, etc. So still 15% invested in any kind of account, can be in cash at home even, and then you buy your first property in cash. All right, just imagine you buy a house. I mean, any small house, you can rent it for a very small house, maybe $700, $800 a month, right? Maybe $1,000 a month, depending which area you're in, for a small house, and that will add to your 15% and make you able to buy a second house. All right, but that's more hassle. Having a real estate portfolio is more trouble. You have to evict tenants. You have to know the law. You have to be familiar with real estate markets. You have to know where to invest and which part of town you want to buy, and so on. So it's more work, more trouble, but it brings a little bit more reward. Mutual funds is more the way to invest for people that don't know so much the real estate market, and it's safer for them. All right. All right. Well, if there's no other question, then I think we should close.